Thank you for joining Money Simplified, your guide to money and mutual funds, presented by Franklin Templeton Mutual Fund. We appreciate your participation. At PersonalFN, we are committed to help investors achieve their financial goals and objectives. Our core proposition is built around unbiased research and financial planning. We wish to thank Franklin Templeton Mutual Fund for partnering with us in this investor education and awareness initiative. Welcome to this special series on life goals brought to you by Money Simplified, your guide to money and mutual funds. We are glad to have you with us for the third session on tax planning, and that is tax planning options for conservative investors. In the last session of Money Simplified, we took you through tax saving options for aggressive investors or risk takers. But if you're averse to taking risk for a variety of reasons, this session is for you. Here, we'll focus on helping conservative or risk-averse individuals to plan their taxes wisely. So let's begin with our session today, and first let's understand who can be classified as a conservative investor or one who's averse to taking risk. Typical traits of a conservative investor. Typically, he or she is in the conservation and protection phase of life, on the verge of retirement or already retired. Very soon would be waving a goodbye to his regular source of income, or already has. May have created considerable assets but now has a conservative approach. Has a low risk appetite in the process of wealth creation. Has liabilities to pay off, has dependent family members and therefore responsibilities to shoulder, and vital financial goals are to be met in the short term. So here are the tax-saving investment avenues for conservative investors. So if you match traits of a conservative investor or one who is averse to taking risk, tax-saving investment instruments offering assured returns would be the suitable choice for tax planning. Let's discuss the tax-saving investment instruments you may consider in this category. Number 1. Non-unit linked insurance plans or traditional insurance plans. Broadly, they are of two types: pure term life insurance plans and insurance cum investment plans. Pure term life insurance plans provide for pure life protection and do not include any embedded investments. They offer a high insurance cover at relatively lower premiums vis-a-vis traditional insurance plans. Insurance cum investment plans, on the other hand, club insurance and investments. For the same premium, the insurance coverage is far lesser than pure term insurance plans. Such insurance plans include endowment plans, money back plans, pension plans, etc. Ideally, you should separate your insurance and investment needs. The insurance premium you pay, irrespective of the insurance plan, is eligible for a deduction under Section 80C of the Income Tax Act 1961 up to a limit of Rs 1.5 lakh. However, one must not buy insurance plans with the objective of saving. It should be purely to cover the risk to life. Next is Public Provident Fund, PPF. PPF scheme is a statutory scheme of the Central Government of India. To participate in this scheme, open a PPF account at your nearest post office or public sector bank or nationalized bank. The PPF account has an expiry of 15 years from the end of the year in which the initial investment or subscription to the account is made. You can invest in the account ranging from a minimum of Rs 500 to a maximum of Rs 1,50,000 in a financial year. You have the convenience of investing either lump sum or in installments not exceeding 12 in a financial year. However, it is not necessary to place a deposit every month, and the amount can be in multiples of Rs 5, subject to minimum of Rs 500 and maximum of Rs 1,50,000 investment limit. Investing in PPF offers a tax-free interest at the rate of 8.1% per annum. You can withdraw from the PPF account only on completion of 6 years from the end of the year in which initial investment subscription to the account is made. However, your withdrawal will be restricted to 50% of the amount that stood to the credit of your account at the end of the 4th year immediately preceding the year of withdrawal, or at the end of the preceding year, whichever is lower. When you complete the term of 15 years, the entire amount standing to the credit of your PPF account can be withdrawn, together with the interest accrued till the last day of the month preceding the month in which application for withdrawal is made. After the term of 15 years is over, You may even renew your account within 1 year of maturity for another period of 5 years without having the compulsion of putting any further deposits in case of extension. The withdrawal in case of extended accounts is permissible once in every financial year, but the total withdrawal should not exceed 60% of the balance accumulated to the account at the commencement of the extension period of 5 years. The contribution made to the PPF account qualifies for a deduction under Section 80C of the Income Tax Act 1961, subject to a maximum eligible limit of Rs 1.5 lakh per annum. Also, the maturity amount received by you or your beneficiary is currently exempt from tax. Next is National Savings Certificate or NSC. NSC is also a scheme floated by the Government of India. You can invest in this scheme through your nearest post office as the scheme is available only with the Indian Post. The certificate has a tenure of 5 years and can be made in your name either singly or jointly by 2 adults or even for minor through a guardian. A 5-year NSC carries a prefix interest at the rate of 8.1% per annum compounded half yearly, thus giving you an effective interest rate of 8.26% per annum. The interest income will accrue annually and will be reinvested further in the scheme till maturity or until the date of premature withdrawals. However, interest income earned on NSC is taxable in the year in which it accrues. The minimum amount which you can invest is Rs 100 with no maximum limit. However, Section 80C tax benefit can be claimed only for an investment up to Rs 1.5 lakh per annum. Any investment exceeding this limit will not be eligible for the tax benefit. Premature withdrawals are permitted only in specific circumstances such as death of the holder. The amount invested in NSC along with the accrued interest of the relevant financial year is eligible for tax deduction under Section 80C of the Income Tax Act 1961 up to a maximum limit of Rs 1.5 lakh per annum. In case if you have no other income apart from interest income, in order to avoid tax deduction at source, you can submit a declaration in Form 15G if you are a general or a non-senior citizen, or 15H if you are a senior citizen to the post office. Next, 5-year tax-saving bank deposit. Banks offer 5-year tax-saving bank deposits as well. They come with a lock-in period of 5 years, so premature withdrawals are not allowed. The prefix rate of interest offered varies from banks to bank. The interest earned is taxable. The minimum amount you can invest is Rs 100, but the maximum allowed is Rs 1.5 lakh in a year. The amount invested is eligible for a deduction under Section 80C of the Income Tax Act 1961 up to a maximum limit of Rs 1.5 lakh per annum. In case you have no other income apart from interest income, in order to avoid tax deduction at source, you can submit a declaration in Form 15G if you're a general or a non-senior citizen, or Form 15H if you're a senior citizen to the bank or banks. Next is 5-year post office time deposit or POTD. As the name goes, this time deposit is offered by India Post. So if you're considering saving tax by investing in this scheme, approach your nearest post office. 5-year POTD can be opened either singly or jointly by 2 adults, or even in the name of the minor through a guardian. The minimum investment can be as little as Rs 200 and there is no upper limit, but the investment amount over Rs 1.5 lakh per annum will not be eligible for any tax benefit. 5-year POTDs earn an interest at the rate of 7.9% per annum compounded quarterly but paid annually, thereby giving an effective interest rate of 8.14% per annum. The interest earned on POTD is taxable. You are permitted to withdraw prematurely but only after 1 year from the date of the deposit. However, the interest earned in such cases shall be 1% lower than the rate specified for a 5-year period deposit. The amount invested in POTD is eligible for a deduction under Section 80C of the Income Tax Act 1961 up to a maximum limit of Rs 1.5 lakh per annum. Next, Senior Citizen Savings Scheme or SCSS. SCSS is an effort made by the Government of India for the empowerment and financial security of senior citizens. So if you are age 60 years and above, you are eligible to invest. Moreover, if you have attained 55 years of age and have retired under a voluntary retirement scheme, then too you are eligible to invest. You are required to open an SCSS account, which can be opened singly or jointly with your spouse, to enjoy the benefits of the scheme. The account can be opened at your nearest post office or any nationalized bank. You can start by investing as little as Rs 1000, but the maximum allowed is Rs 15 lakh. SCSS offers an interest at the rate of 8.6% per annum payable on a quarterly basis, that is on March 31st, June 30th, September 30th, and December 31st every year from the date of the deposit. However, the interest earned by you is taxable. SCSS has a maturity period of 5 years. After maturity, you can extend your SCSS account for a period of 3 years, but within 1 year from the maturity by giving an application in the prescribed format. Premature withdrawals too are permitted, but only after 1 year from the date of opening the account. If you withdraw between 1 and 2 years, 1.5% of the deposit will be deducted, and in case if you withdraw after 2 years, 1% of the deposit is deducted. But in case of accounts which are extended after maturity, the accounts can be closed anytime after expiry of 1 year of extension without any deduction. Investments up to Rs 1.5 lakh in SCSS are entitled for a deduction under Section 80C. If you have no other income apart from interest income, then in order to avoid tax deduction at source, you can submit a declaration in Form 15G if you are a general or a non-senior citizen, or Form 15H if you are a senior citizen, to the post office or bank as the case may be. Next, pension funds. Pension funds offered by mutual funds can not only be used for tax planning, but also as an effective instrument to plan for a peaceful retired life. Most pension funds typically allocate a predominant portion of their assets in debt and the rest in equity. Conservative investors may avoid any pension fund with a predominant equity component. However, pension funds do carry some element of risk vis-a-vis assured return products owing to their market-linked nature. They have a higher potential of wealth creation over the long run than assured return products owing to the equity component. At the vesting age, you may choose to withdraw fixed amounts at a regular frequency through systematic withdrawal plans or SWPs to meet your retirement cash flows. Being a debt-oriented scheme, they are subject to long-term capital gains or LTCG post-indexation benefits. The amount invested in pension funds qualifies for a deduction under Section 80C of the Income Tax Act 1961, subject to a maximum limit of Rs 1.5 lakh per annum. So here's a snapshot of the assured return tax saving instruments if you are averse to taking risk as an investor. You have Public Provident Fund, National Savings Certificates, tax saving bank deposits, post office time deposits, senior citizen savings schemes, non-ULIP insurance plans, also known as traditional insurance plans, and pension funds which have some variable component while giving returns. Here are the points to remember. Tax planning is a year-long exercise. Complement tax planning and investment planning. If you are a conservative or risk-averse individual, consider investment avenues across market-linked and assured return products. Avoid buying insurance just to save tax. Ideally, keep your investments and insurance needs separate. Public Provident Fund proceeds are tax-free on maturity. Interest earned on National Savings Certificates or NSC is chargeable to tax in the year in which it accrues. If you are age 60 years and above, you may consider investing in senior citizen savings schemes. Likewise, if you have attained 55 years of age and have retired under a voluntary retirement scheme. And last but not the least, if you are looking at serving two objectives, planning for retirement and tax saving, you may consider debt-oriented pension plans offered by mutual funds. They have a higher wealth creation potential owing to the equity component. So to end our learning exercise today, we now invite you to test your learning by taking this simple quiz and win exciting prizes. Thank you for participating. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.